Hey, welcome back to the latest episode of Retirement Insights. So I have a random question for you. So when you think of the city, Louisville, Kentucky, what comes to mind? You may think of, the Kentucky Derby. You may thinking about tasting a fine bourbon or even Kentucky Fried Chicken. But for me, I associate Louisville, Kentucky with Becky Swansburg from Stonewood Financial. Becky, welcome to the show.
Thank you so much for having me.
And anyway, I just want to give people a little bit of background on who you are and why I'm having you on here. So I actually met you a little over a year ago at one of your conferences. I think it was an Innovate conference. And basically what Stonewood does, and maybe you can fill in the details, Becky, but what Stonewood does is that you ultimately teach financial advisors like me across the country more about, tax risk, legislative risk, and lots of things that we advisors don't really learn in our normal education. Is that a fair assessment of what that is?
Very much so. So much financial planning is focused around mitigating the risks of the market and how do we generate enough income for savers. And those are very important. Mm-hmm. But the missing piece is, of course, not just how much income you can generate, but how much of that income do you get to keep versus how much of that income do you end up sending to the IRS in the form of taxes. So that tax planning piece is kind of the final missing puzzle piece to really getting a strong plan for retirement.
Right. And I've learned so much from you. One of the phrases that you've mentioned, and it's stuck with me, is that I think a lot of people do good planning, but they kind of focus on investments, maybe a little bit of insurance. But if you don't have the tax piece in plan, you use the phrase, your plan is not complete. And I love that. And it's absolutely right. So thank you for that nugget of knowledge, because I use that all the time.
Well, I love that. I'll have savers say to me, did I save the wrong way? And I'll say, no, of course. You haven't saved. You haven't done anything wrong. It's just not complete yet.
Exactly.
And I love that phrase, complete, because that's how we need to be thinking as savers here in America right now. We've done good work in the past, mitigating market risk and income risk. And now we need to focus, especially in these political times, on tax and legislative risk.
Absolutely. And one of the, again, the slides that you had, I love this. You had this thing, and I'm starting to use it in my presentations. You said there are two systems of taxation in our country, one for the informed and one for the uninformed. And I think that's so right. So many people will just kind of put things on autopilot and just, put money in the 401k or this and that. And they have no concept on what the tax ramifications are, when you start pulling the money out. Yeah. So I love that phrase right there. So one of the things I want to kind of give us some background is a little bit about the history of taxes. If you want to talk about it, or I can talk about it, but you
it's
go
interesting.
about it.
This is the top federal marginal individual income tax rate through history. Mm-hmm. And one of, I think, the challenges with this graphic is when you look at it, you think, well, we're not in that high of a tax rate environment right now today. Mm-hmm. Better today than in the 40s and 30s when we had that, 94, 97% top rate. Right. The challenge is that back in the 40s, that top bracket rate only applied to about 100 Americans. And today, obviously, our top rates apply to many, many more American savers. Right. So it surprises a lot of people when they've seen graphs like this to discover that actually our tax bracket rates today are about 30% lower than historical average. Mm-hmm. Then let's say tax bracket rates were for, middle income savers just even in 2000, in the late 90s and early 2000s, they were about 30% higher than they are today. And that's because of the federal tax reform we saw a few years ago, sometimes called the Trump tax cuts.
Right.
So it's easy to feel like, great, we're in this lower tax bracket rate environment, but those tax bracket rate reductions expire next year. So come 2025, they expire. Come 2026, all of our tax bracket rates are reverting back to their older, higher rates. And that means that even if we do nothing, if we earn the same income, if we don't change anything about our lifestyle, all of our taxes are looking like they're going to go up in 2026 because that federal reform expires.
Right. And so you and I were in Washington fairly recently with NAFA, the National Association of Insurance and Financial Advisors. I think that's what his name
Yeah.
stands for. But basically, you were a guest speaker, and I had 4 meetings with 2 of my congressmen and 2 of my senators, and I was trying to talk to them and said, give me some insight about where things are going. What should I tell my clients? And nobody knows. I think maybe they may try to do something and not have all the tax, cuts revert back. But I mean, no one knows. So I think what I'm telling my clients, and maybe you would agree with this or not, but just plan for them to go up. If they don't, hey, that's great, but let's plan for a rise in taxes, because the worst case scenario is they stay where they are, and that's fine. So anyway,
Yeah, I would like to tell savers, if you only plan to be retired for the next 4 years, I can help guess, we got an election coming up.
Right.
What is that going to mean for your taxes? But of course, none of us just want to be retired for the next 4 years. We want to be retired for the next 20, 30, some of us even 40 years into the future. And what that means is that we're really trying to mitigate not just this upcoming election cycle, but 15 to 20 election cycles in the future. And that is hard to do. When I look at kind of the spending landscape, the federal debt landscape, everything going on in Washington, it is really hard to see a way where taxes do not rise. Maybe not next year, maybe not the year after, but certainly during the span of retirement that we're all looking at. And that's a huge issue if, like so many millions of American savers, listeners have all of the majority of their assets in these tax-deferred retirement vehicles, 401ks, IRAs, 403bs. All of these popular retirement vehicles have been great at helping us defer taxes while we work. But of course, we have to pay all those taxes in retirement. So if taxes are higher in the future than we expect, it's less money in our pocket to spend in retirement.
That's right. So I've done a couple episodes just on that topic. So guys, go back to my YouTube channel and go back and have a little more information on that. But that leads me to a couple things that you talk about in depth. One is tax risk. Why don't you kind of define what tax risk is?
Yeah, I'll define it, and I'll give you a preview of, I bet, what your next slide is, which is talking about the difference between tax risk and legislative risk.
Absolutely.
Both are really important for savers to understand. Tax risk is about your level of taxation in retirement. It's about, in retirement, let's be very honest, there are only 3 things that can happen to your taxes. They can be lower than they are today, the same as they are today, or higher than they are today.
That's right.
And so tax risk isn't necessarily trying to predict with certainty which one of those scenarios will be true. Mitigating tax risk is all about making sure that your retirement approach is okay if taxes are different in the future than planned. So if taxes end up, a lot of us deferred our taxes in 401ks and IRAs, hoping we'd be in a lower tax bracket in retirement. What happens if our tax bracket stays the same or is even higher because of some of these forces in Washington? How do we make sure that our retirement approach is still okay?
Right.
Now, very closely related to that, obviously, is legislative risk.
Right.
I knew it.
Yes.
Legislative risk, I think, is one of the biggest emerging risks that savers need to keep their eyes on. Legislative risk is about the structure of taxation in America. It's about what is taxed, when it's taxed, how it's taxed, and who it's taxed for. So with tax risk, we're often looking at what are our bracket rates, kind of what rate am I going to pay taxes at? But under legislative risk, it's also kind of the structure of how Congress is changing what is taxed and when it's taxed. And that may not impact your bracket at all. A great example of this was in 2019, Congress passed something called the Secure Act. And as part of that Secure Act, it changed the way that people are taxed when they inherit an IRA from, let's say, a parent that passes away. It used to be that when you inherited an IRA, you could kind of take the money out when you wanted and pay taxes on it. But now Congress has changed the rules. And now Congress has said if you inherit an IRA or a 401k, in most cases, within 10 years, you've got to drain that account, which means that you cannot manage the amount of income that you have to pay taxes on because you have to drain it within 10 years.
That's right.
It's a great example of where Congress didn't necessarily change your tax bracket rate or your tax rate, but suddenly your heirs could end up paying a lot more taxes than planned because they don't have the same flexibility to manage when they want that money.
That's a great point. And that's just one out of hundreds of examples.
Oh, yeah.
And so why don't we talk a little bit about how taxes can change? I mean, they could change today, but they could also kind of change in retirement. So, what are some of the ways that taxes can change for anybody at any age?
Yeah. So this is perfect. So I'd start with situational tax changes. And these are the ways that most of us actually think about taxes changing in retirement.
Mm-hmm.
Situational changes are things that have to do with us. How much income do I need? What tax bracket does that put me in? Also, am I filing jointly, or at some point in retirement, do I become widowed and file at a single rate? Now, a lot of people think that situational tax changes are a reason their taxes could be lower in retirement than they are today. I am finding with many savers, particularly in the baby boomer generation and younger, that they are not willing to make the lifestyle cuts that, let's say, the greatest generation made to get their tax brackets lower in retirement.
Mm-hmm.
So my grandparents were greatest generation in retirement. They didn't travel. They tried to only eat early bird specials. You know, they got the 50-cent coffee for senior citizens at McDonald's. They really lived a very tightly budgeted life. Well, in that way, they could get into these lower brackets. But then I look at my parents who are baby boomers, and I think this will be true for all the generations that follow. They don't want to take lifestyle cuts in retirement. You know, my parents want to travel extensively when they retire. They want to eat out and go on vacation and take their grandkids places. And because of that, if they're not going to take a lifestyle cut, they're going to need to maintain the relative same amount of income, which of course means that they may maintain the relative same tax bracket that they had before retirement.
Right. And I say that all the time, Becky. It's like, if you want to maintain your standard of living, doesn't that mean you got to say, you're basically, besides the contributions to your savings, or you can take that out, but everything else is, you're going to be taking out the same amount of money. Where's that money going to come from? And for the majority of people, at least 50% of most Americans' portfolio are in qualified plans that are subject to taxation. So that's a great point. We talked a little bit about the legislative risk, but how can that possibly affect people in retirement? I mean, that's also another kind of topic as well.
Yeah, so it's interesting. The other piece that I think savers don't think about, we're always thinking about ourselves and things we can control in retirement.
Mm-hmm.
Legislative tax changes have nothing to do with us.
Right.
They're just new rules that Congress passes. And nothing has to change in our life, but suddenly we find ourselves paying a very different amount of taxes, like we talked about when those Trump tax cuts expire next year, and bracket rates might revert to their older, higher rates. So the legislative risks, even if personally you believe you could get into a lower tax bracket in retirement, Congress may come change those rules and it might upset your plan. And again, it's like when we're planning for retirement, we're not really planning for what happens if the market does double digits every year for now until forever. That would be great. But what we plan for, what we prepare for, is what if the market doesn't do as well as I need? How can I make sure my retirement approach is still okay? It's the exact same on taxes. What we're planning for is not maybe your taxes will be lower in the future. It's making sure that your retirement approach is okay if your taxes stay the same or even rise because of something in your life or just because of changes Washington decides to make.
No, you're absolutely right. And, and so taxes, again, you've kind of put this in some of your presentations, and we've heard this from Biden. He says, no one making under $400,000 will have their taxes raised, and you brought up some interesting points where, I'm not sure if that's really accurate, right? And so why don't you talk about sort of like middle America, like the middle quartile people, how that affects, taxes.
Well, let me say before we get to middle quintile, we've heard the president and Democrats in the House and Senate really talk about this promise that no one making less than $400,000 a year will have their taxes raised, period. And I like to tell savers that is just not true. It's not true because the president's lying. It's just that is not how we fund our country. So it's very easy to say just tax the rich. But what's interesting is that people that make $400,000 a year and above only pay about 39% of federal income taxes. People that make $100,000 a year and above, anyone in a six-figure income, those households actually pay almost 90% of federal income tax. So for tax reform to work, for it to generate a lot of money for the country, it's going to have to be much more broad-based. The Cato Institute, which is a think tank out of Washington, actually did a study last year where they looked, what if we taxed at 100% every dollar that Americans made over $500,000? Let's just take all the money. And they found that, unfortunately, even taxing it at 100% could not close our annual deficit here in the country. We'd still be about $600 billion a year short. So we know that tax reform is going to have to be much broader based to be effective. Now, this is actually what I was mentioning before. Oh, go on.
No. This is it. I mean, you're kind of talking about that we're roughly 30% ish,
yeah, 30%
less,
off.
Taxes than we were just in 2000. And so, 28% tax bracket in 2000 versus 22 today. Now they're constantly shifting around, right? I mean, Congress, they will change not only the tax rates, but the brackets that they're in. So that kind of, is constantly kind of swirling around. And, you're the 30% higher in that. So, and that's one of the things that we've seen. If you actually look at the tax history, those brackets are all over the place. Depending on where you are in those brackets, you could easily jump from the 22 to the 28% tax bracket. There's these little overlap areas that you can do that. And so I don't think people really understand the impact of just, tax bracket, what I call style drift or, creep or whatever.
And look, if we're 30% off historical norms on these rates, there is tons of room for Congress to come in and make adjustments.
Okay, so talk a little bit more about deductions. I mean, this is not tax rates, right? This is stuff that you can deduct, So any thoughts on that?
The thing that I think savers need to remember is that a lot of the deductions that are very sacred in the U.S. matter less the older you get. Mortgage deduction as you pay off your house isn't important to you. I hope that none of us in retirement have dependent children that we can deduct off our taxes.
Right.
So I think the real thing with deductions is just, it is easier to rely on those the younger you are. Sometimes we have to remember that as we age, of course, we can take the standard deduction, but we just start to lose some of that benefit from some deductions.
Right. I mean, we could talk forever about that. And obviously, Congress can certainly add new taxes, and that's something that could certainly happen. I mean,
this is the area where I think Congress will really look to, because it's easy to say, okay, we won't change brackets on someone, but there are tons of new taxes that they can add that don't impact brackets at all. So a great example of this could be, Jim, Social Security. So listeners may know originally Social Security was not taxable.
Right.
And then in the 80s under Reagan, Congress passed a law making it taxable up to 50% of the benefit. And in the 90s under Clinton, Congress passed another law making it taxable up to its current 85% of the benefit.
Right.
But there's no reason that tomorrow Congress couldn't pass a new law and make it taxable up to 100% of the benefit. Again, your bracket's not changing, but suddenly you're paying more in taxes. You have less income to spend. Your entire retirement tax bill has gone up.
And I just gave a Social Security seminar 2 nights ago and last week, and still there's people that are shocked to learn that Social Security is taxable in certain tax brackets, right? And so that's a big deal right here. So, the main thing I want to tell people is that, you really need to know, first of all, you need to be aware of the taxes that you're going to be subject to in retirement. And as we've said multiple times today, majority of your retirement money is going to be in pre-tax accounts, which is going to be fully taxable on the way out. And so one of the things is that if you go to my website, jimmusgrave.com, just scroll down on that homepage and you can actually request a free retirement tax bill. You just put in a little bit of minimal information and we'll actually email you that report, and that will give you an estimate of what your tax is going to be in retirement. And there's a little page in there, Becky, as you know, that talks about required minimum distributions, and you just see those numbers getting bigger and bigger and bigger every year, and you're going, oh my God, this is crazy. So, I always encourage people that it starts with awareness, and once you're aware, hopefully you'll be motivated to take some action. And so, yeah, again, you can plug in some information into the tax report. Very simple. And again, I always encourage people to, go to my website, and you can request the slides that we kind of talked about. You can get the tax reports. And again, you can go to our podcast page. So I'm going to wrap this up on this episode, Becky, but listen, you guys don't want to miss the next few episodes, because we're going to be talking about some more things. In fact, next episode, we're going to be talking about, will the national debt, how will that affect our investments and our retirement? So in our next episode, we're going to get deep into the actual debt, and it's going to be mind-blowing about what's going to go on. So listen, Becky, thank you so much. Hang around, and we'll see you next time on Retirement Insights with Jim Musgrave.